view. Say for example, I'm bullish on Hong Kong stock, but only bullish for 10%. So that's why, what is the cheapest way to achieve your view that you are bullish on something, but you're not very extreme bullish, just bullish for a short period of time, or a very specific amount or specific range. So that's why through the structured product you can create an instrument that have a positive view of 10%. Then you have less cost. And also with a particular view or strategy. And secondly, you can combine different views into a single structure. So that's why instead of, if I'm bullish on US, I'm bullish on Hong Kong, I'm bullish on something else, but I'm bearish on something other market, you can combine this view into a single product. So that's why you don't have to spend so much time and so much transaction cost into a single structure. So, and also they will allow investors to access certain underlying assets in foreign countries, which they have no direct access, especially some emerging markets. For example, like right now, if for a Hong Kong client who want to buy African shares, or he want to buy Indian shares, okay, and then or buy Korean shares. Right now, actually, it is quite difficult for individuals to buy Indian share or Korean shares. So that's why bank would like to offer a structured product that you can, by entering into a structured product, you can have access to the economic rights or the views of the market that on those foreign countries. And also, the structured product will give some flexibility in booking and transact after securitization. So after it is being securitized and fungible. So once you create that structured product and then it is being created in a security format, so you can sell and buy in the secondary market if this is somebody will quote it, or you can transfer from one bank to another bank without the OTC restrictions. Because, say for example, when you enter in the OTC contract with, say for example, HSBC, you cannot or very difficult to transfer this economic from HSBC to another bank. But with a fungible note, so you can always transfer this note from bank A to bank B without changing the terms. And also the structured note or structured product can incorporate leverage effect. So there will be enhanced leverage inside. For example, right now for the US market, you can buy three times leverage QQQ or 3 times short US Treasury long bond. So these are actually essentially a listed structured product. So incorporate the leverage on that. So now we have talked about we have talked about the benefits of structured product. Now we can talk about the risk. So something, as I mentioned before, so whenever you have some benefit, you must be, there's some cost. The cost will be the risk or the inherent cost. Some of the key risks of the structured products are there. So credit, the counterparty risk of the issuer. So remember that all these structured products as before, they will be issued by a counterparty or issuer. So that's why this is the one that honor the terms of the structure. That's why you're taking the risk of the counterparty. Second, the counterparty or the counterparty risk of the guarantor. Because some structured notes, sometimes they may issue by a special purpose vehicle for transaction purpose, but they will usually guarantee by another person, okay, another organization. So that's why you're taking the either or, you're taking the counterparty risk of the issuer and also taking the counterparty risk of the guarantor. So, and also you are also, for some structured product, there will be another swap transaction counterparty in the structured product. So that's why you may enter into credit risk of the swap counterparty, if there's any. And of course, straightforward, talking about you are subject to market risk, disregard what kinds of market instrument you are underlying is. Say for example, equity, you will subject to equity market risk. If this is a currency link, you're subject to currency risk. And then, as I mentioned before, these structured products are mainly OTC, that's why the pricing risk is pretty high. Say for example, if you want to get out of the structured product, you can only approach the issuer. And if you quote the price you think it is unfair, sorry, no choice. You still have to deal with it, or you just hold it to until maturities. So my experience that some clients do encounter some when the market is not very good, and then since the issuer doesn't want to take back the instrument because they have to unwind a lot of transaction costs, it does price a very lousy price. So that if you want to sell, doesn't mind, so we can make a good spread. And then if you don't sell, doesn't matter because the counterparty already assumed you are not selling. Volatility risk, this is another thing, depends on your underlying. If your underlying is a leveraged buying of equities, so probably the volatility will be pretty high because you're leveraged. If your underlying is just a long against a US Treasury bond or a bond fund, then the volatility will be a lot lower. So the volatility risk will be a derived volatility of the underlying. So it depends on your underlying structure. If you have a leverage, then the volatility will be definitely a lot higher. And then the volatility will not be exactly the same as the underlying, depends on the structure. Say for example, if you have if your volatility of the underlying is a buying options, so when it is out of the money, the volatility will be a bit lower. When it is in the money, the volatility will be higher. So it all depends on the structure. And also, some of the structured products will have early redemption risk. They may have some terms that they can allow the issuer to early terminate, so that your return on the future or immature tenor will not be fulfilled. And of course, settlement risk is that some of the structured products may take some time to settle, and then that's why there will be some settlement risk. So these are the pros and cons, or the risks and benefit of the structured products, and not necessarily mention to you whether structured products are good or bad. So it's just a phenomenon or just a feature of the structured product. So it can be good and can be bad, depends on market timing, depends on how you use it, or whether you use it properly. So here I would like to do some basic revisions of the options. So I think all of you have studied options, right? In your derivative course, but I still want to do some option revision. So basically, these are the most common types of options you use in the structured product. So like long call, when you long call, that means you pay premium to buy the right to buy. This is long call. When you short a call, that means you become the counterparty of the long call. So you receive a premium, and then you have the obligation. If somebody wants to buy something, say underlying, that you have to fulfill the obligation. That's why, by knowing that, longing a call, your loss will be limited. The only loss is your premium to pay. And the outcome can be very good, depends on whether you're fulfilling the outcome. And short a call, the loss can be maximum and then very exaggerated, because by receiving a premium, that means you will obliged to fulfill the term of the contract. Same for long put and short put. Long call is to buy something going up. Short call, you think something will not go up, that's why you short call. And then long put, you think something will go down, and then short put that you think something will not go down too much. So if you think something will go down, you never short a put. So, and then long underlying assets. So if you think the S&P will be good, you can buy the S&P, or you can do a forward by entering into a counterparty with a cheaper funding cost, or you do an equity swap. So we'll explain what is the equity swap later. And then short underlying, same, just the reverse side, and the put call parity relationship. That means through the put and call, basically you just like you longing the underlying asset. So on the graphical presentation, this is the payoff chart of the long call. So your cost will be the premium, and the maximum cost is premium, and then the upside is unlimited when you long a call. when you short a call, so basically your return will be the premium you receive, but the downside is unlimited because you short. If the underlying goes up, then your loss will be maximized. Same for long put. So when the market goes down, and then your payoff will be higher. And then for shorter put is the reverse. When your return will be maximized, will be limited, but the downside will be unlimited if you short the put, if it continue to go down. So this is the long underlying asset. So if it goes up, and then the higher the better. And this is the short underlying asset. So this is the interesting. So remember that when the short call, when you look at the payoff, long and call and short and put, if the strike are the same, basically it will just like combining all together will become just a single underlying long or short the underlying. So put call parity means when you long and call and short and put, or when you short a call and long and put, basically you combine together will become just a straight line on the market. When it goes down, you make more, and when it goes up, you make less. So a basic revision, I won't spend time on that. So if in case you don't understand, you can ask me later or after the class. So apart from the basic options, right now because of the geniuses and also the computer systems, the calculating power, we have a lot of these interesting or exotic options. These are non-traditional options. So for example, like the most common one, I will just use the most common one, like for example, the exotic and the barrier options. That means you set a barrier. So whenever the either up or down, whenever you see a barrier touch or not touch, then you have a payoff. So basically that you can imagine a situation that if it happens, I will get something. Or if it don't happen, I will also get something. So this is we call it barrier option, you set it there. And then binary option is that either or. So this is we can, for the binary option, sometimes in the industry we call it the batch option. So just like when you go to say when you for the binary option, say for example the Hang Seng Index is now 1700 points. So you can create a binary option with the trader. Say for example 1 year time, if Hang Seng Index touch 1800, 18,000, what is the payoff? You can always create something like that. So that's right. And then the trader can calculate the payoff according to the volatility, according to the interest rate expectation for the 18,000. So you can imagine that if now Hang Seng Index 17,000, 18,000 is the payoff, if the target you will think you achieve. Say for example, if the payoff 1 to 5 times, would you like to buy it? Say if you touch 18,000, and then I pay $1, and then the payoff will be $5. So probably it's a very good payoff, but depends on the tenor. If the tenor is 1 week, probably it's not a good payoff. So that's why the tenor will affect the option pricing a lot. And then the rainbow option is that when the underlying is involved, two underlying, and then you will see the correlation of this movement of the underlying. So we call it correlation index. So and then this is very widely used right now for the correlation index on the structured product. For example, like the equity linked product. Usually the equity linked product is only under one underlying, but now people like to put into two underlying, and then you get the worst payoff of the underlying. So that's why it will be determined by the correlation options, the payoff. Okay. And the other barrier option is the how to make use of the barrier option is that usually the barrier, what we call the knock-in or knock-out option, an option where the payoff depends on whether the underlying asset reaches a certain level of the barrier during the tenor of the options. For example, under the call, so there will be an up and out call or up in above call spot. So if it cross become worthless, otherwise it will become just like plain vanilla call. Say for example, you buy a call option. So when you buy a call option, normal call option is just like that. When the market goes up, you get more. And then this is your strike price. So you pay the premium. So this is a simple call option. So what does it mean that I will put a knockout? Say for example, the knockout is here. So that means that if the underlying price go and then touch the knockout price within the tenor, this will be gone for sure, and then all the options will become zero. So that means if they touch the knockout, the option will be lapsed automatically in vain. Then so that means the payoff will be the option will be and then you will have nothing. So these will become your payoff area. So that's why, as compared to the original call, like that, so which one is better? Yes, the original call is better. So that's why the second one will knock out, definitely they will cheapen the option premium. So probably the option premium will be like that. Will be like that. So that's why you pay less. So in case, so say for example, when you buy the normal call, will be like that. When you buy the cheapened knockout call, will be like that. So if your view was wrong, it doesn't go up, so your cost is cheaper. But if your view is right, really goes up within, doesn't touch the knockout, then your payoff will be a lot better than the original call, because it's cheapened by a lot of the option premium. So this is the example of an up and out call. So I can show you some. second one is a similar structure, so it's up and in. So your call option will not be effective or will not be enforced until it touches the knockout. So this is also cheapen the call, but however it is less widely used. So and down and out is on the opposite side, is that if it goes down, the option will be worthless. Otherwise, the plain vanilla call will be enforced. Or down and in is that if it goes down, the option will be enforced. Otherwise, it will not be enforced. So all this, by adding into some of the knock-in, knockout, all will be cheapen the options. Because you create another constraint that will make it a lot difficult to fulfill. Okay, up and out, put, same if cross, worthless. Up and in, down and out, and down and in. So I will have some example to you later. Okay. For binary option or digital option with discontinuous payoff, it will be easier to show, but okay, later we will chart. So ordinary binary or one-touch binary. So here is the payoff chart. So you see that nothing happened until it's touched, then it will be one fixed payoff, and then if you exit, there will be no payoff. So it depends on the situation. So this is a long a binary or short a binary. Depends on your writer or which side of the counterparty you are in. So why various options? So various option payoff may more closely match the belief about the future behavior of the market. Say for example, for this example, they assume this is like Hang Seng Index. Underlying handle. Say for example, strike is 17,000. And then if I set it at 20,000 for 6 months. So 10 out of 6 months. So if you buy a call, say for example, you need to pay X. If you need to pay X amount of premium. And then say say 20, so assume say 5% premium. Assume, say for example, if you set a knockout level at 20,000, say it's 2.5%. And then you're not so sure whether your will be right or wrong. So you substantially cheapen your cost by paying half. And then if you're right, then your return will be magnified by your savings of the cost. Because you think about it, in 6 months' time, touching 20,000 will be quite minimal, quite remote. So that's why you would like to do a knockout. But if, say for example, right now, if the tenor is 1 year, probably you will think a second time again, because if this is 1 year, the probability of going up from 17,000 to 20,000 will be a lot higher, because time is in your favor. So in that case, if I place a 5%, I buy the call, and then if I pay 2.5% by a knockout, then if it really knock out, you get nothing. That means your view is right, but you're not making anything. So by saving 2.5%, you lose your all possibility of the gain. So which is quite, so that all this will depends on the pricing and your view and the tenor. So the so I don't say that there will be what is the best strategy, but people will calculate based on the historical volatility. So here are the example of barrier options. So this is the illustration of the in and out options that, say for example, for the one that we have talked about, the down and out, if this is a call, if this is below spot, then because that means it will be out. So say for example, if the down and out situation like that, if it goes down, the knockout is here. If it goes down, the call will be vaporized. So that means if your view was wrong, because it really, but when you long a call, even though it goes down and then goes up, then it's still okay. So I have problem in loading my Bloomberg, so better use my writing. So let me use an FX to illustrate. So assume right now euro. Euro to US dollar is 1.08. So 1 euro to 1.08 US dollar. So what does it mean by down and out? Is that, say for example, the spot here. And then my strike 1.08 call. Knock out 1.05. So what does it mean? Say for example, under the FINA 3 months, say for example. So what does it mean then for down and out call? Is that, say for example, if normally I buy a call 108 strike, spot 108, if in the maturity date it is 108 and above, I will have value for my call option, right? I can buy euro at 1.08. At maturity, 1.10, say for example 1.10, 1.1. So you make 200 points for this trade. But say for example, if within this period, if euro like that, now it's 1.08, 1.04, 1.12. If the pattern of the euro like that, it drops to 1.04 and then go back to 1.12. So under the normal call option, I'm still okay because when maturity I can buy euro at 1.08. Now it's 1.12. That's why I make 400 points. Clear? But however, because I have a knockout here, so if you drop to 1.05 but below and out, so if you drop below to 1.04, my option will be expire or lapse because it's a knockout. That means even though it gone up to 1.2, nothing concerned about me, so I have no money, no cost. But when you incorporate a knockout there, the cost will be substantially cheaper, but you're subject to a higher risk of not making it work. So this is the down and out call. And then down and in is just a reserve. We reverse that. So if the normal call is 1.08, so it's okay. Disregard what happened. As long as it is higher than the spot, I will make money in the end of the day. But if this is down and in, that means he had the euro has to go down before it goes up. So you think it's much more difficult, right? So that's why the call option will be a lot cheaper under these circumstances. That's why the down and in is that if the option, if the spot price below the spot and then become a standard cost. If not crossed, it will be worthless. So it is a completely opposite. So up and out, same is that, say for up and out, say for example, if the knockout is 1.14 for up and out, I bought a 1.08 call option. So if in the end of the maturity is 1.12, I'm totally fine, right? It doesn't knock out. But say for example, if the euro goes up to 1.15, my option will be knocked out. So that's why under this case, so it will become worthless if we cross. Otherwise become a standard call. Same for up and in is that, so for up and in, say for example, if you need it to go up to 1.14, knock out, not knock in. In this case will be a knock safe and knock in. Then the option will be invalid, but the impact on the knock in call will be less because it's the same direction. So usually the knockout or the barrier is in another direction will help out a bit on lowering the cost of the option. So remember that whenever people put a barrier of the option, the objective is to help it to cheapen the cost or shorten the tenor. Depends on your view. So I think I will be showing some examples. So here are some of the numerical example of a down and out option. Say for example, the stock price is $100 and the barrier is 90, and then the time to expiry is 1 year. So the volatility is 15%, the dividend yield is 5%. All these are parameters. So because you need all these to calculate the option premium, and the risk-free rate is 10%. And then the core value, standard European core value is 7.84, and then the down and out will be 7.2. So to cheapen by a little bit for the down and out option. It doesn't mention it is a core, or is it core? Okay. So up and out call, for example, like the stock price is $100, you buy the call strike at $100, and the barrier is $120. So and then the call value will be 11.45 is the traditional call, but up and out will be only you pay 0.6%. So that means it's cheapened by a lot. But however, because according to the volatility of the stock, so the knockout probability is very high. So that means most probably you won't get anything on the payoff because once it touches 120, you get nothing. So standard put will be like that with the up and out put will be like that. So really depends on the direction of the bet in order to determine the option value. So I use another example that like the sterling one. So like currency up and out option is that like sterling to US dollar is 1.3589, 10 or 6 months. If you buy a call, will be around 1.9325%. However, if you put into barrier option. It's like same tenor, same spot, same strike. However, you have a knockout 13780, so you cheapen the cost by half. So you can see that the variations. So if, say for example, within a 6 month time, the sterling goes up but did not touch 13780, your return will be a lot better. However, if once it touch, you get nothing. So that's why if you're very bullish on the underlying, you never do the knockout option. So this is the usually right now for nowadays we don't have to use the own calculator. So all these instruments from the Bloomberg and then a lot of the financial math instruments they will feed in the market volatility data, the interest rate, and also the forward points, the interest differential, and then they will calculate the premium. Or they work out different, if you set the premium, you can work out the strike, etc. So common applications, so this is another option here. So why do people used to use the knockout barrier option? Is that basically the common application of barrier option is in the callable bull bear warrants. So this is very common in Hong Kong. A lot of small investor, retail investor would like to bet on this Ngao Hong thing. You heard from the radios the bull bear warrants, and then a lot of people will use the equity market on the private bank. They use the accumulators as the example of the knockout option, and then why they call it somebody give name call it accumulator, because it is a delayed loss for the client if he doesn't use the instrument on the right way. And then also the FX knockout forward is also another example that come up for the options. So as we talked about before that, apart from the traditional single underlying options, some options we would like to combine the payoff, which depends on the relative performance of the two of the more assets. So a rainbow option gives the holder the right to buy or sell the best or worst of the two securities, or option that pay the best or worst of the two assets. So basically that instead of, say for example, if you buy a worst of put, then the exercise will depends on the underlying that has the perform the worst. So that means if you're selling a put, you will get the worst between the two underlying assets being delivered. If you're buying the worst of call, say for example, if you're two underlying the Apple stock and Microsoft stock. If the Microsoft gone up by 10% and Apple gone up by 5%, since you long the worst of call, your payout will be based on the performance of the Apple, not performance of the Microsoft. So this is the correlation of option. We call the rainbow option. So how do we use these correlation option or rainbow option? Is that basically basically is that for the classification of structured product will be under the Swiss Structured Products Association. They will mapping the least risky to more risky products as the classification. So basically, these are the four categorized for wealth management. They use a lot is the capital protected. So capital protected structured product, yield enhancement structured product, participation structured product, or leverage with leverage and embedded leverage structured product. And also there will be some external or margin financing will increase the risk. So basically the leverage fund will have some external and internal leverage on that. That's why the risk is a lot higher. And then these products, according to the risk profile, will be like that. Say like the lowest risk will be the capital protected product, but at the same time they have the lowest risk and then lower return. While for the yield enhancement will be in the middle. The participation, because it's more directional, that's why you will gain according to the direction of the underlying better. And then for the leverage one, which is the highest return but also the highest risk. For example, like if there's a lot of the leverage ETF in the financial market, like in the US, you have the CQQQ, which is 3 times of the Nasdaq movement. So if you buy it right, you can make a lot of money. Not like also the TLT also leverage the 20-year bond treasury. And also there will be also some short QQQ, which is also leverage. If you drop more than, so if you drop 1%, your profit will be around 2%. So this is magnify the performance of the underlying instrument. So I will go over the product features one by one, and after the break, I will focusing using the examples to illustrate all this. For example, like what are capital protected products? So the capital protected product equals to an investment plus long a call or long a put. So basically is that they will use the present value of the interest and may be part of the principal for less than 100% principal protected to buy the call or the put option of the underlying asset. So basically is that the client will give up the interest rate of the underlying instrument and then use the interest rate part to buy the present value to buy the options of the call or put option. So the participation rate is the percentage of the participation in the upside, depends on how expensive is the option contract or the option premium. Normally, no or guarantee income. And then normally will be long term, and so that because the longer the tenor, you have more interest to buy the options. That's why you can buy more options. So this is the payoff chart of a capital protected products. So assume the underlying move like that. The lower the price, the higher the loss if you buy the underlying. However, when you enter into the principal protected product, then your principal will be guaranteed according to life cycle. If it goes up, you can get more. So it depends on the payoff. So normally we will not have better performance than the underlying because the option premium is more expensive than interest rate under normal circumstances. So let me use an example for illustration. So say for example, I want to invest in say for example, I want to buy Japanese market. Right now, not a lot of people talking about Japanese market. Okay, so buy Japan equity. So the underlying the Nikkei 225 index fund. So the best way is that you buy it in the K index fund, right? So easy. So if you buy it in the K index fund, if it goes up, you goes up, you go down, you go down. And then think about that. So the K is in the Japanese yen. And now you have the US dollar as a principal. Because most of the client holding US dollar in his portfolio. Think about that. So if this is one way that you can, if you're bullish on the K225, you can buy the index fund, and then if it goes up, you make money. If it goes down, you lose money. Say for example, your time, 10 give yourself 1 year time. Okay. If I think that now the K is say 3,000. 3,800 points, and which is almost the close to the historical high and has been rising for so long. And I'm afraid that if I'm wrong, then if it goes down, I will lose money. So and then the banker now comes and okay, you can buy a 1 year principal protected note on the K 225 index. What does it mean that, okay, now you pay US dollar 1 million. You give me 1 million, and then you underline the 3,800 spot in the case. Call, so you put it. If 1 year from now, if in the K go up higher than 30, your payoff will be the K at 1 year minus 3,008 over 3,008. And then you will not be negative because principal protected you will not. So if the K goes up, then you have payoff, the other will be 0. So basically, after 1 year time, you get back your US dollar 1 million and also the payoff of the Nikkei index. Sounds good, right? Is it possible? Do you think is it possible? Yes and no. So it depends on a lot of parameters. So right now, depends on what are the parameters affecting option pricing when you study. So. One, interest rate. 2, what? Mainly the volatility of underlying. And third, the dividend yield. So think about that, when you buy the Nikkei index, you will have the dividend yield, and then the K pays around 3% dividend yield, I think, something like that, I forgot. And then the volatility in the K is not very high, but it's okay. So that's why the option pricing based on volatility is not high. Although Japan interest rate is 0, so that's why it's pretty cheap for option. So that's why the K index is pretty cheap. And then think about that, because you're now or original currency in US dollar. So that's why your US dollar will have 5% interest rate. Plus, if you buy in the K, you say 3% dividend. So by entering into this contract, the principal protected, you give up the interest rate of US dollar and also give up the dividend, because it will price in the K based on the spot price. Right? Because if you buy the underlying, you have the dividend. Now you don't have the dividend. So basically, you are using this 8% to buy the call option. So you have the 8% of high call option. Maybe, okay, depends on the quote. Maybe you can buy as one option. That means equal 1 to 1. Or you can buy 0.8 of option. Or 0.7, depends on the terms of the option or the spread. So basically that, I would say most probably you will get, for the K, I didn't do the pricing, but probably you will get quite similar to 1 to 1. But if you have a view of 1 year holding the product, it's still a good bet. Because anyway, you don't want to sell, but in case you're wrong, you will not have, you won't subject to any loss of principal at maturity, but you lose the interest rate. But you have the opportunity cost and you have the upside when the K goes up. So this is one thing. Another thing is that, more than that, is that when you enter in this contract, for these structured products, usually you don't have secondary market. That means if, say for example, if after 6 months time, if in the K goes up from 38,000 to 41,000, I want to get out. Sorry, you cannot get all the payoff, even though the option is in the money. The people will quote a price probably charging you a pretty high spread. So that's why you have to lose the possibility of exit. So that's why, apart from this 8%, you also give up the liquidity preference. The liquidity premium do have some price. So that's why it's more than 8%. So then, by evaluating all these pros and cons, I still think that for the client that really want to protect the principal but also want to run up, this is still a good deal. If we can sit for 1 year. So it doesn't work on 3 months because 3 months you cannot price option, call option on such thing. Or some people will say that, okay, I want a high participation. I don't mind losing some principal. Maybe you give up, instead of 100% principal protected, now you become a 95 principal protected. So that means at the end of the contract, I still get 95% of my money back. But because you're now taking another $5 to back on the upside, so maybe probably you can buy more options. So all these, as I mentioned before, all these structured products, if you're smart enough, you can break it into different things. So that's why we call it a structured product. Then we remember in the early lecture that we said that all the structured products must have interest element, must have a note, must have an option, and all these things combined together. So basically, just like a combination of efforts. So if you are like the investment banks or the hedge funds, they will not do this structured product. What they will do then is they put the cash in the deposit and buy a plain vanilla call option. And then so that the plain vanilla call option will give them a more flexibility secondary market to liquidate and then do some hedging or whatever. So, and then also when you issue a note, you have to pay some issuer's fee. So that's why this is the structure of a capital principal protected product. So I explained the market and also the dynamics and also the pros and cons. So here are the why and what are they. So the market expectation, you have a rising underlying rate. I'm bullish on the case. And then there will be possibility of rising volatility. That means the option will become more expensive. So now you pay cheaper. So also there will sharply falling underlying possible. So in case I'm wrong, or in case a war happens, so my downside will be protected. So characteristics is that you have minimum redemption and expiry. So as I mentioned, you is protected, and then may be equivalent to the principal protection. So capital protection is defined as the percentage of the nominal. So like 100%, 90%, 98%, 85%, whatever. So the capital protection refers to the nominal only and not to the purchase price. So be careful regarding the terms. So value of the product may fall below its capital protection during its lifetime. So during lifetime, say for example, because of interest rate movement, and then remember that the principal protector is only on your face value, $100, and then the interest rate. So essentially, in the first day, there will be discounted price on the NPV of your note. So that's why what you say, the value of the product may fall below its capital protection during its lifetime. So participation in the underlying price increase above the strike. So any payout attributable to the underlying are used in favor of the strategy. So capital protected product is value at issue and maturity date. So use the PV. So what we do is we use the PV of all the coupons and maybe part of the principal to buy the put option or call option. So as I mentioned before, so use the $5 and then the $3 dividend yield. And maturity, the payoff will be either 100% principal plus the upside if the strike price of the option is in the money, or 100% principal only if the option is at or out of the money. So in maturity, if the K below 3,800, nothing happened. I got that my principal. So I assume I did it wrong, so I lose my interest. That's it. But I still protect myself if in case 1 year down the road in the K become 3,000, 30,000, then I save a lot of capital loss. So that's why every financial product, every structured product have pros and cons. So depends your view and how you use it. If you are, say for example, I'm very bullish on Japan, I just want to trade for a couple of months, probably this is not a good product for you. Because if it goes up, you cannot unwind, or your unwind price is not very lousy. So that's why not very good for you. But if you hold for maturity, if the option, say for example, if the Nikkei goes up by 38,000 to 42,000, and then the payoff will be exactly equal to the difference, according to the formula. So example of principal protected product, like say 3-year principal protected linked to Hang Seng Index. The note is a principal protected note on maturity with coupon linked to performance of Hang Seng Index. There's a participation of 20%. So this is something that we did before, and then because the interest rate was so low at those days, but now when the interest rate is so high, so I think the property payout will be a lot better. So 3-year 90% principal protected note linked to Hang Seng Index. The note is 90% principal protected on maturity with coupon linked to the performance of Hang Seng Index, participation of 50. So if you give up 10% principal protected, probably you can buy half of the option, so 50% participation. So the pricing determinants, so you see that interest rate and tenor. The interest rate and tenor will determine how much money you can use to buy the option. And then the Hang Seng Index call option pricing will be affected by the dividend level, as I mentioned earlier in the K, the strike level, whether it is at the money or out of the money, or participation level. Say for example, if I cannot buy a single participation 100%, instead of buying 3,800 call, I buy a 40,000 call. It will be a lot cheaper. So if it's gone up, I'm very bullish, I still make money. If it goes wrong, I lose a bit less option premium. So all these can be tailor-made and then priced. So that's why in the investment bank, they have a lot of models with a lot of scenarios. They like if increase the strike, what is the impact of the option premium, or decrease the strike, what's the option premium effect. So examples of a capital protected product like bullish view of underlying assets, like it is like the formula how to calculate that you use the present value of all the coupon divided by the cost of the call option, then will be determine the participation ratio. Say for example, the cost of the option is $100, and then you have only $80 to buy the option. So probably you will you'll buy 80% of a single option, then the participation, PR is participation rate, the participation will be 80% of the upside. Okay, let's stop here for a break, and then we'll come back with the yield enhancement products. Yes, probably for all the OTC. think that for Nikkei, all these common products is quite transparent. So they don't last year, because for each structured product, it doesn't cost too much for the 1 year bond. The 1 year bond doesn't too much. Because 1 year bond is 1.5%. Say for example, 1 year bond is just gone up by 1%. But after 1 year, it's the same. So if 10 year bond is a much better, you multiply by 8 times. And it's a whole lot. But if it's high enough, that's why you have to expect saturation. Or you won't be so stupid to separate very low down. Because it was not. Kind of start with the buyer and seller together. But normally we don't assign the person and what kind of options that we play was easier than American writers right now why or before there will be less use because they will compete. But for this structure partnership, single we do encounter similar things before. So just feeling unhappy or fair. Then if you know that you want to buy, but the point that you have to wait until because all the value will be factored. discuss later about the different product everybody thinking
Single line.
US government is so kind of it's an issue. They still have risk. But of course people think they can credit risk. But otherwise it's more trade settlement. Okay, let's continue for some the second part of the structured product. We call the yield enhancement. That's the most attract the most attention from the private investors in Hong Kong and the region. So as you can see, the yield enhancement product is an interest rate bearing instrument as a short or write an option on the underlying asset. So the examples of yield enhancement products are like the equity linked note, as actually the most basic yield enhancement product in the street. Sometimes we may call it reverse convertible. The second one is called the dual currency deposit or the premium deposit, which right now a lot of retail banks also offer this product. Or on the first one, some banks will call it a ELI, equity linked instrument, and then lots of retail banks also offer this product. And then some of the other one is we call the fixed coupon note, which is give you a periodic fixed coupon during the life of the contract. So think about that. Usually they have an underlying and some coupon. So this is the payoff. This is the characteristics of the equity linked note. So also called the equity linked deposit, equity linked investment, or reverse convertible in Europe. Basically, the investor sells an equity put option to the issuer and receive the option premium as future higher interest rate. So it is a downside unlimited structure. So this is the payoff chart. So so you can see that the dark black line is the underlying instrument. So say for example, if the market goes up, and then the payoff will go up, the P&L will go up. But however, for the equity linked note, actually if the market goes up, you will not have the upside because you will receive just the premium. But when the market goes down, you will deliver the share, and then you will have a limited downside, depends on the underlying share performance. But since you will see that the payoff is not exactly the same line as the underlying line, because it will be shift a bit upward because of the option premium you receive. That's the coupon of the note that helps. So this is the Bloomberg calculation. Say for example, which was done some time ago. This is the underlying index. Underlying instrument is at 10 cents. At those times it's $470. And then it is you can see that in the selling a put option, the strike is 437.1, which is 93% of the strike. And then the expiry is 180 days, 6 months, and then the option premium will be around 5.99%. 5.99% here. Here. So this is the option pricing. 5.9% here. That means by receiving 5.9% on selling the put option, you will honor the client that you will honor that the bank will sell you 10 cent share for this 437.1 if the share price goes down below 437.1, that means you are selling a put. You are selling a put option at the strike 437.1 in exchange of $6, around $6. This is the option payoff of the underlying. So this is the option payoff chart. So this is how we calculate the structure. So it is a 6-month tenor, 182 days. Equity note reverse convertible linked to 10 cents. Then pays a coupon and maturity. Either you will receive the principal plus the interest at cash, or the principal and cash is converted to 10 cents share at 407. That's right, 470. So the strike release should be 437.1. If the transaction is below 437.1, then you will exercise. So please change that. And then the issue price is 95.25. So the payoff, what will be the payoff if fixing at 440? What happened? If the 10 cent share at 440 and maturity, what do you get? Anybody? What will you get if the maturity is fixing at 440? And the number one scenario. Anybody? Yes. You get. What do you get? You have sold a put on the strike 437.1, now it's fixing at 440. So will the option be exercised? No. So you get back the cash at 100 because you're paying the note at 95.25 and then maturity paying back 100. So you effectively you earn 4.75 on this structure. So 4.75 translated into interest, then you can calculate what's the interest rate. So what's number two scenario? You're fixing at 420. What do you think will happen? Anybody? So assume you investing 1 million Hong Kong dollars. So on day one, you pay 950,500 for 1 million notional, and then at maturity, if the payoff, if it's fixing at 440, then your payoff will be 1 million. And fixing 0 to 420, what will happen? So you will get 1 million divided by 437.1 equal to, give me the number, and somebody do the calculation. 1 million divided by 437. What's the calculation? How much? Give me number. Can everybody give me number? Calculator. Can you calculate? How much? 1 million divided by 437.1. 2,087. Okay. So if the 10-cent share posted at 420, you will get delivered 2,028.87. So what does it equal to? Because the market price is 420. What's that? What's the value, market value? Anybody can calculate for me? 2287 times 420.
960540.
Okay, so now your market is only 964540. So what's the cost? What's the P&L? So your cost is 952.5. Now 960. So basically you still making money, right? Because you're paying 952, and then now you still got 960,000. You still make money because 10 cents doesn't down too much. Because the Q point is more than compensating the downside. So what's the underlying yield? How to calculate the yield? For this scenario. So the underlying yield will be like 1 million minus 95.2. Okay. Divided by 286 days. What will be the percentage? So you get, these are the money you make, right? You get 1 million by paying 952. This is the discount coupon. So divide by 182 because under 82 days, and then you calculate the annualized yield. What's that? How many percentage? 14 times 2. And then over 1 million. Over 1. What's that amount? What's this amount? Anybody?
0.095.
Okay.
That will be
0.09.
9.5%.
Okay.
Yeah.
9.5%. So the return will be 9%, 9.5% for this structure. If this is an early call, if this, if it is mature with the not exercise, so in case it is exercised, then the will be a lot higher. So, however, I have a twist. So this is what we have been calculated. So P plus I 100%. If the fixing is 230, you get 228 plus the residual amount. So if the underlying yield is 10% per annum, roughly 10% per annum. So, however, what's the built-in spread? We would like to know the bank make how much money. So how do we calculate so the PV of the money market of the principal is 3,000. Option premium is 60,000. So the notional, because remember that in the previous pricing here is 6%, right? Option premium. When we sell the put, you receive 60,000. And then the present value of the money market principal will be 3,000 because this is the Hong Kong dollar interest rate is there. So that's why the 1 million minus the PV or 93.7, is making 1.55% because he charged you 95.25. So basically all this you can calculate out how much the money makes you if you have this calculating methodology. So don't miss out that the interest on interest element. So a lot of people will forget that. So unless interest rate is zero, because interest rate did, especially now interest rate is very high. That's why that part counts a lot. The yield enhancement. So that's why the original yield is a lot lower. So now with the 60,000 premium, you get a lot higher yield. And then fixed fund deposit 2.6%. Now it's 3%. That's a lot different, a lot bigger. Any question on this example? How to calculate so in real life working, you don't have to calculate all this because all will be done by the computer. But I still want you to know that the underlying methodology, how the number comes out, so you know that what are the elements that affect a lot. For example, right now, because now if you use the same example today, this is not 0.6%, this is 3.5% at least. So that the PV will be a lot higher. So that's why you should demand a lot higher than this yield. So at least you get 12 or 13% in order to use the same option premium. So this is because what are the figures that are available in the market is that if you go to all the Bloomberg or all the Hang Seng, Hong Kong Stock Exchange, you can easily get the volatility of the stock, and then if you have good enough, the computer model will can calculate roughly the option premium. Clear? Okay. Next one, dual currency deposit, which is very popular among the housewives to go to the bank to do this dual currency deposit. And then if you look at in the old days, when the currency volatility is very high, a lot of these just like to sit in the bank to watch which currency to attach the link. So the dual currency deposit we also call the premium deposit or enhanced dual currency deposit. Which is investor sells a currency put option to the bank and receive the option premium at high interest rate in the future. So essentially it's similar to the equity number, but just in currency format. So example. So assume you have Australian dollar on your account, and then you want to invest in Australian dollar deposit. But of course, Australian deposit will be a lot cheaper. So you want to link to US dollar, and then you don't mind to convert back to US dollar. And then the tenor is 1 month, and the strike price is 0.762, and then premium interest rate is 3.4%. So if the terms are like that, disregard what is the spot will determine the pricing, but the terms are like that, the other 5 lines is the terms. And then the valuation day, or if the Aussie fixing below 7620, the return will be 2.4% per annum. And then at valuation, if the US dollar fixed at or above 7620, the principal plus interest will be converted to US dollar at 7620. and then there will be market loss because Aussie definitely will be higher than you will be converted. So what is the underlying option? So can you tell me what is the underlying option? If you enter into this DCD, what is the underlying option? You'll be exempt on these things. Okay, yeah, you are selling an Aussie call. So this is the option that this is a tenor. So spot rate is 75.08, and then the strike is 76.20. Then you are selling a call option, the current call option on Aussie dollar. That means if the currency, and then everybody, do you know the quotation of the Aussie and US dollar? So did anybody understand the quotation? They have the different quotation for currency pairs. So for Aussie dollar, 76.20, that means one Aussie equal to how many US dollars? Same as euro. Euro quote, say for euro 108, that means 1 euro to how many US dollar? The reverse is on other currency, like for example, like Hong Kong dollar is 1 US dollar equal to how many Hong Kong dollar? So it's different. Like for example, Canadian dollar is 1.35, then it's 1 US dollar equal to 1.35 Canadian dollar. This is the quote currency and the term currency. So you can, but for Aussie, it's quite a market notation that whenever it takes 76.20, that means it's one Aussie equal to 76 US cents on one Aussie dollar. So that means Aussie is cheaper than US dollar. So when Aussie goes up, that means you sell a call on Aussie, and then that means you sell a call on Aussie, that means you sell a put on US dollar. So it's a pair. So basically that you sell an Aussie call, and then if it goes up, you have to sell your Aussie, and then in return you get the 3.4% yield for 1 month. So very little, because the volatility of Aussie dollar is very low. But at those days when interest rates are so low, that's why people like to do that. So let's do some game or exercise. Say if I have 100,000 US dollars, and then now I will just say, for example, the bank pay me 4% interest rate. And then 1 month. If I want to link to Japanese yen, the spot price 150, and then I will set the strike 152, and then the premium 0. What will be the yield of the ECT dollar base converted to yen at 152. Can somebody calculate? You know how to calculate it? Simple, straightforward. What will be the yield? So here's that. What is the option and better option? You are selling. US dollar call, yen put option. By selling this US dollar call yen put option, that means if US dollar goes up, you have to sell the call, so to sell the US dollar to the client, so to the bank, right? Or if the yen goes down, so if US dollar goes up, that means yen goes down, right? So if the US dollar goes up and then yen goes down, that means the US dollar goes up from 150 to 152, that means yen depreciate. Then at this strike or worse, you have to sell your US dollar and buy yen at 152, the strike. And in return, because you enter this option, you will receive 0.3% premium. So how to translate into the yield? Say for example, you have invested 100,000. You're investing 100,000, so 0.3% equal to how much premium? Times 100,000. How much? $300. So, okay, forget about the simple present value, because this 300 present value is so little, so forget about it. So for easy calculation, but in computer you can exactly calculate it, calculate the PE. So right now, what we would like to do is that we can calculate, because 4% deposit for 1 month, how much you will get?
$333.33.
333.33, right?
Oh, yeah.
333, make it easier. 1 month deposit. So total you get 633. So 633 translated into yield, what's that? For a month, if you're 100,000 principal.
333 over 633.
333 over 100,000.
Oh,
12 months. This is 1 month. Calculate yield. 633 times 12 divided by 100,000.
okay.
Should be 8 something. Should be more than that. But 7.6 there. Roughly less than 8% because less than. So roughly that means now you're earning 7.6% instead of 4%. So this 3.6% is yield, we call it yield enhancement. Because so by entering all this, your deposit will be earning 7.6%. Why? Because you're selling an option premium, you're selling option here. So if the dollar doesn't go up, nothing happens. You will receive principal plus interest at 10.6% and maturity. If dollar goes up at say 1.135, say if a maturity fx equal to 153, what happened? Your P plus I divided by 1 times 153, sorry, 152 is right, equal to yen amount. Then you can calculate. So that means at maturity, if the dollar yen is 153, so your P plus I will be converted into yen times 152 as a strike, so you get a yen. Then, so if you are intended to buy yen at 152, it's better, right? Because in any case, you think you will buy at 152, now you get even more interest, then you still can get 152. But if you don't want to buy yen at 152, then you should not do that. Or you think that if yen, for example, not 152, it's 160, then maybe you lose the opportunity because you already converted 152, then you cannot convert your money in 160. So that's why this is the pros and cons of DCC. So first of all, so when you do the DCC, what's your expectation? So think about that. The instrument is that the wheel is light. So in order to how to say, for better choice, better choosing what instrument, what strike I would like to use, that you must have a view. Say for example, for this Aussie, you have the Australian dollar. Okay, if you think Aussie will go down, what should you do? You should sell your Aussie dollar and copy the US dollar, right? The only thing you will do that you think Aussie would be silent, it doesn't move too much. But at the same time, I can earn a high interest rate. It doesn't matter, I would like to hold Aussie dollar. And then in this case, I have US dollar. So I think US dollar may not go up too much. Or if US dollar goes up a bit, I don't mind convert my principal into the yen at a cheaper rate. Because now it 150, 150, I will convert my yen in 152 in 1 month time if the US dollar appreciate. So, and I don't mind holding yen because I will go to Japan to use it. This is something that tie into your view. However, if you think the yen will appreciate a lot, you should not do that. Because say for example, if the yen not as 152 is go all the way down, you start 140, 138, then because you lock up into this deposit, you cannot sell your stuff and buy yen. You're locked up already. So that's why you cannot, so you miss the opportunity to buy the yen because you locked up the higher yield deposit. So that's why whenever you, for all these yield enhancement, product, your view is that you expect the future volatility will be sideways or lower. That's why you capture the premium. If you think that the volatility will be higher, you should not do that. Because otherwise your risk will be a lot higher. And then you will stuck or lock up with that, and then you lose the visibility to do more trades, or you end up having a higher loss. Say for example, if the yen really depreciate a lot more than I expected, then I will subject to market loss. Or sometimes people will say that, oh, anyway, I don't mind if I were to go to 152 already convert my yen, so it's okay. Some kinds of treating yourself is okay, but in actual case, you're still losing the opportunity to buy a cheaper yen because of lock up that trade. So basically that for all the structured products, you must have a view first, and then you can choose which structured product will be better for you. Or by understanding, by look at the structured product, you will know actually why people pay you higher. There must be something there. Otherwise, nobody will be so stupid to pay you a bit more. So in investment, when you see some abnormal return, higher than normal return, there must be some tricks. And then your job, or as a wealth advisor or the manager, you have to find out whether the risk is justified. Say for example, if the volatility is a lot higher, so I should demand for a higher strike in order to get 7.6% yield, because I think the option will be worth a lot more. Then you should not do that. Then you have to find a better price. So this is something that, because right now simple vanilla option is very transparent, easy to say. You can ask for different banks, but a lot of the trades that happen in the commercial bank or the retail bank is that they will quote similar thing. Say for example, what they will do is they quote similar thing like that. Dollar yen, 150, and then the strike also 150. they will usually put in the money, and then they will take yield, say like 10% to you. Very high yield, looks very attractive, or even 12%, but only for 1 week. So a lot of these tricks will on the retail bank that they will give you a very eye-catching. Oh, I give you very high yield for 1 week, but the trade is a lot riskier. So in that case, basically, the chances of losing is very high. Because think about that, if you enter into this trade, 12% for 1 week and then strike 150 at the market. So the probability of getting strike is very high. First, whenever you get strike, that means you will lose principal, right? But at the same time, you have very limited upside because 12% per annum for 1 week is very little. The absolute amount is very little. So, and then if you do nothing, say for example, you do nothing, if the yen appreciate, I still can. If say for example, it's dollar, if yen appreciate, in any case I won't lose. But if yen depreciate, I can buy yen in a cheaper way. But because in this case, if the yen appreciate, also you won't get anything because you will not participate in any upside of the yen. Just sell the dollar call. So think about that when I would say a lot of people structure the product, make it more eye-catching and looks attractive, but if you do the analysis, some people will be disguised by the high yield percentage, but actually for a short period of time it doesn't mean anything. Even cheaper than the commission you pay sometimes. So any question on that for the ECD? Next, so now we will come to we will start from the most simple structured product capital protectors. Right now we change to a bit more yield enhancement, and then from the simple vanilla ELI, we would like to change it into So I would like to change now into a more complex structure. Verse of put, executable note, or verse of put option. So basically this is another instrument that the investor sell a verse of put. That means they sell two, not say a single put option, but there's a two underlying. And then the payout will depend on the worst performing stock when the market exercise. So look at this one. So we still have the basic elements. So we have the issuer, HSBC. So issue date is 2021 December, and then final variation is 2022 June, 6 month maturity, a 6 month contract. The underlying is a euro currency, and then the notional is €500,000, and then they issue the note at the multiple of 10,000 euros. And the coupon rate is 10% per annum. And then the denomination will be, the coupon will be denomination times coupon rate times the time ratio. And then the time ratio is bi-monthly. So every 2 months, they will pay coupon for every 2 months. And then the auto call, they will issue an auto call. Auto call, that means this is a knockout. So that means they improve the call probability of the knockout. So the observation date, that's why the bi-monthly call, the observation will be each 2 months. So the starting date is December. So the first call date will be February, April, and June, 3 quarters. And that's two underlying. The first one is the ASML. So ASML is the largest semiconductor manufacturing equipment plant in Netherlands. And then the second is Siemens. Siemens is the industrial conglomerate in Germany. So the spot price is 684.7, and the conversion ratio is the strike price is 534.5 on the ASML, and then the for Siemens is 116.9. So what is the strike level of the contract? How to calculate strike level, percentage of strike? So you choose the strike price divided by the spot, they will calculate the strike level, and then determine how much is the our money. So let's see what's the strike. So it is 78% of the spot price is the strike price roughly. Same for the Siemens. Yes, 116, something like that. So the early redemption, if both underlying stock price is higher than the optical barrier on observation days, there will be early redemption. So if there's early redemption, the note will be early call, and then the issuer will pay the interest plus the principal back to the client on the early call day. So if it is called on the first 2 months, then you will get 2 months coupon. So if this is not called throughout the period, the final redemption, if no early redemption occurs, the underlying stock, the final redemption will be equal to the underlying stock price. If this is strike lower than the strike, the worst performing stock will be delivered according to the conversion ratio. So that means if in the end of the period, if the share price drops below the strike, they will choose the worst performing stock to deliver. So why and what are they? So what are the market expectations? So we would expect the market underlying moving sideways or rising slightly, so that you will not be delivered the stock, and then you will earn the yield. And then will be a falling volatility. That means the possibility of getting strike is even lower. So should the underlying close below the strike and on expiry, the underlying and or cash amount is redeemed. Should the underlying close above the strike and expiry, the nominal plus the coupon is being paid at redemption. The coupon is paid regardless of the performance of the underlying. Reduce risk compared to a direct investment into the underlying. So with higher risk level, multiple underlying will allow for higher coupon. So say for example, for this example, we have 2 stocks. If you increase into 3 stocks, so the probability of getting put will be a lot higher, because 3 stocks, the correlation will be quite different. And that's a limited profit opportunity for this one, because you only get the upside is your coupon. Okay, let's go through it step by step. Okay, using this example. So, notional euro 100,000. Coupon, how much? 10%. So means each period you will receive 500,000 times 10% divided by 6. Why 6? Because 2 months, right? 1 year you have 12 months for simple calculation. So by monthly is every 2 months. Usually people will, in the bank, they will define it as 30 days per month, easy calculation. So that means you will have 10% is 50,000 times divided by 600. Not a single number. $8,333. Okay. So right, 8,000. So that's why on day 1, I will be out 100,000. Day 60. Day 60, I will get 8,300. Right? On first 2 months on day 2 months. Day 1. On the settlement day 1. Okay, then because the first month will, so if ASML SI Siemens above the knockout, auto call. If both above the knockout level, and so if on the first, according to the contract, if both underlying stock above the auto call barrier on the observation days, it will be early call. So that means the whole deal finished. The result will be 500 plus 8,333 equal to 10% per annum. Right? So scenario 1. Okay. If scenario 2, okay. If what happens? No call, no early redemption. Because it does not fulfill the auto call criteria. So no early redemption. Then to observe another 2 months. The 4th month. And then you will get another 8,33321. And then you will see observe again. ASML, SIE. This time, both stocks above the auto call level. Then it will end, but in the 4th month. So your return right? Because So this is the second scenario. So that means you will make 6 months performance interest. However, if, say for example, this time like that, Siemens below or even both below, they will still continue. So as long as one of them is below, we will continue. So then we will continue with like that. Next month or the final month, because the standard is final. Then you get another 8333 coupon. And then observe. If ASML, SIE above what this time? Above what? Because it's a final maturity, no more auto call, because you don't get the auto call area. You, as long as above strike, then no conversion. So remember, as long as above the strike, the put option will not be exercised. Then you will get result 500 plus 8333 times 3, because of 3 times interest. So these will be the best scenario for this trade, because you get the 10%, the full tenor, and without conversion. This is the best. Market is the best, and the highest return for this trade. And then, so that's why the scenario 1, 2, and 3, all no conversion, but you get the coupon. So this is the 3 scenario. So will there be a 4th scenario? Okay, say for example, under the 4th scenario, first month is not called, second month is not called. And then on the last month, the strike price, the ASM is below the strike. They like below strike and then the market. ASML say is 532, and Siemens is 108. Both are below strike, for example. Siemens 108, ASML is 532. What happened is that your principal, this time only the principal will be converted into Siemens share, and then you will deliver the Siemens share, because this Siemens, according to the formula, Siemens performance is worse than ASML. It dropped more than ASML. So that's why you will get Siemens share. So, but if say for example, ASML is like 550, even above the strike, you still got Siemens share, because whatever, you get the worst performing share among the two. Worst of, that's why the worst of, that's why we call it worst of put. So you will get delivered. So only situation you will get cash is that both stocks above the strike. If one above, one below, you will get the strike of the that below the strike price, the share below the strike, or you get the if the both stocks are below the strike, then you get the worst one. So if you remember, Siemens 108, say for example, easy to calculate 100. Say if your notional is 500,000, so the 100 divided by 100. So you will divide how many shares? 5,000 shares. sorry, divided by the strike is 116. So you can deliver 4,275 shares. 4,272 shares. So you will be delivered 4,274 shares plus the interest. Because this interest you have received the last one you will receive. So you, in the end of the day, you get 4,274 shares plus the interest. So if you mark to market, what does it mean? 4,274 times, because it's 100. Is 4274 times 100. That means the principal will be 400. Mark to market. So mark to market 400 plus the interest of these, you still mark to market loss because you get the interest share. But your choice is that you can hold the share until it goes up. So you don't know whether in the end of the day you're still losing your money or not, but mark to market you're lost. But you can hold it. So this is the structure. So any other scenario? Do you think there will be another scenario? Will convert. The one below will be converted. If both stop below the strike price, the worst one will be converted. If only will not be converted, they all above the strike price. So the best scenario is all above the strike price. So this is the scenario. So that means the maximum return will be the scenario 3, or positive return will be scenario 1 or scenario 2. So you will call on the first one, you will call on the second one. And then the third one is the scenario that you will get delivered to shares. But you may not lose because if the strike is exactly 115, then you will not lose because similar to the strike, but your coupon will more than compensate the price difference. So it really depends on the strike. So, but it seldom happens that when the first 2 months is not called, the third month will be called rather than strike, because that means the third price are not necessarily sorry. So it's possible. So this is not. It should be like that. One is below, so that's why it's not called. So because if both stock are above the auto call price, it will be early terminated already. So under this scenario, so the strategy is that when you enter this strategy, you think that your objective is earn the high yield. It can stay, the best is that it can stay there within the narrow range, then will be better. That means if you both stop, if one stock goes down, it doesn't go down too much, it's still okay. So you have the cushion of strike level is 78%, right? So your cushion of 22% downside cushion in case it goes down. Is it 22%? 78, right? Yes, 78%. So you have 22% cushion for this trade for 6 months. That means you will buy the stock at 20% cheaper than the stock price, with also will compensate of the interest rate, and then make the break even a lot better, because these help your break even, the coupon. Any question on this example? Clear? Think about it. Okay. So I have attached some of the samples in this. Yes.
Where's the 78?
78 is the
Thank you.
usually people will quote in a percentage of the what is right. Because I say, for example, if I give these two to you, sometimes you cannot figure it out what's the difference. Because some it will be, with the 78% will be better. So there's a lot of variety. So think about that. This now will be a 6-month contract by monthly call. Somebody will put it as a monthly call. So every month will be observed. So do you think which one will have a high coupon? Same, everything is the same, so only the one monthly call. Instead of 2 by monthly call, do you think which one will have a high coupon? The monthly call, because it will be easier to recall. Because if you more observation, that means more possibility to recall. But because of your observation too close, that means your coupon will not be locked. Because at least when I do the first coupon will be locked up. So it depends on that's why the possibility of the call is higher, and then the coupon will be a bit higher. But the bank will like you to do the monthly call because they want you to be two again to bank commission. So sometimes for this kind of trade, I see some bank will quote is a 1-year tenor monthly call. So think about it, the possibility of you getting all the early call will be higher, and then it's quite difficult for you. If you're right, the view is right, it's difficult to get the whole 10-year, whole 12-month coupon. When you get the whole 12-month coupon, probably the stock price has dropped a lot. That means it's not called. So this is the tricks on that. But in essence, is that whenever you enter into this transaction, you think the market will be going sideways, neither going too much high or going too down too much. Otherwise, if you think the market is very bullish, why not just buy the stock market as a spot? If you continue to go down, you make even more money. So this is something that is more of a yield enhancement. You don't expect it to drop too much. So this is a very common product. If you want the risk to be lower, then you do a 3-month contract. Yeah. So next, the participation products. So we have think about it. Right now, the earlier products, so we don't have upside participation, the yield enhancement, the equity, no FX1. Now we talk about the participation product have upside potential and no capital protection. Basically, they are linked to the performance of the underlying asset. Sometimes we call this a Delta 1 product. Why? Because a lot of people do not want, as I mentioned before, somebody may not have the access to certain market. That's why we want the investment bank to create this a Delta 1 product for them. Or they want to create their own Delta 1 product and do not want to buy into so many executions. So what and why and what? So usually you have a rising underlying expectation. And the characteristic is that the participator in the development of the underlying, participate on the underlying, in fact underlying price move one by one, adjust by conversion ratio and any related fees, and the risk comparative to a direct investment into the underlying. So example, Participant basically the ETF is one of the participant or tracker fund. So when you buy into ETF, you're buying into the underlying performance. Or equity certificate linked to baskets of stock traded OTC, or passive trackers and active trackers. So a lot of the investment bank would like to create this Delta One product for the hedge funds. Say for example, I'm a hedge fund. I want to buy the global EVs. I'm positive on the global electric vehicle sector. So instead of buying the different market, so say for example, I should buy the Hong Kong market, I should China market, I should buy the US market or European market or Japanese market, whatever. I have so many stocks I want to buy. So in that, sometimes they will ask the investment to create an index, a basket index stock for them, and then they will execute through the investment bank. And then the investment will give them financing, that's why they can leverage. So that in that case, they will be cheaper in terms of execution, because when you get out, you can get out at once, and then the investment bank will do the execution for them. So make it easier to track, and then easier to calculate, and then just give some fee for the investment bank. So we call it the Delta One trading. So these usually probably they do passive tracker, or active tracker is that they will sometimes they will change the tracking. So these are the underlying of the Delta One ETF tracker fund. So when you incorporate leverage, you will magnify the returns, but at the same time also magnify the loss in case you are wrong. So there's two types of leverage. One type is that they will embed the leverage in the market, in the product. And then the second leverage is that they will lend you money to enter into the structured note. Say for example, if for this one, this is in euro. If I don't have euro, but I have US dollar bonds, I don't want to convert my US dollar bond into euro. So that's why I can use my US dollar bond as a collateral to ask the bank to lend me euro so that I can enter into this euro note. So in that case, I'm essentially leveraged two times. Say for example, if I borrow 50% of a bond and then buy this product, and then this product will have a loanable value for me for 50%, that means I put up $50, I can buy $100. So the return will be not 10%, will be 20% for leverage. So this is something that the leverage will work. And the first one is that they will leverage according basically on the product, as I mentioned, like the 3 times QQQ and then 2 times semiconductor ETF, something like that. They create this pro-share leverage ETF, or the accumulator basically is a margin product. You put down 20%, 30% of the notional, then you can buy to 100% of the product. In case you're wrong, your loss will be magnified by a couple of times. Then warrants. So warrants are basically buy or sell a future contract. It's a warrant, a put warrant, a call warrant. So basically this is the payoff. If you buy a put warrant, then if you go down, you make money. If you buy a call warrant, you go up, you make money. Then your maximum is the option premium you pay. So why is this call warrants? Usually the warrants are listed in the stock exchange, so that's why you can have a secondary market. While the option is always OTC, and sometimes the warrant is a bit longer in tenor. Option is usually a bit shorter in tenor. And then warrants will be usually issued in a standard term so that people can trade on the warrant, like this CBBC listed in the stock exchange in Hong Kong. The other contract is futures, buy or sell futures contract on margin basis. So like you have index future, S&P futures, and then Dow Jones futures. So you can buy or sell future contract on a margin basis. And then there's for the future contract, there's a very standardized futures. And then usually each contract represents how much money, and then they have a very strict margin process. Say for example, if you buy I forgot the margin requirement. Say for example, like you have to put down around 10-20% as the margin, that basic margin. If it goes up, then your margin will be increased because market. If the underlying goes down, you have to top up the margin. They will ask you to top margin. If you cannot top the margin, the exchange will stop your contract and then realize your loss. So that's why the future contract has a future exchange have a very standardized procedures regarding all this, and then they will be settled on the futures. And think about that, when you do the futures, your counterparty is the future exchange. So you don't know who are the counterparty. That's why in these cases the funding counter risk will a lot lower because this future exchange usually will be monitored or governed by the regulators, and they have a huge system and a huge margin in between. Because if you long a future, that means somebody on your opposite side is shorting a future, and this also go through the exchange, and the exchange will make sure the one who short the future have enough deposit and the margin for it to settle. However, one story that during the 1987, I think most of you have not born yet. During the 1970s, we have the stock crash, stock crash in global stock crash, and Hong Kong Stock Exchange stopped trading, suspend trading for a couple of days. That's why people sue the Hong Kong Stock Exchange, because you stop trading, how can I settle? Because I cannot square, I cannot unwind the contract. So that's why, and after that day, one of the chairman of the stock exchange was being reprimanded and then being put into jail because of the interest. So these are the futures contracts payoff. So apart from all these structured OTC contracts, and there's one instrument I will especially discuss with you is that the people will use the longer tenor bond types of investment to enhance the return of the investor. So a corporate bond is issued by a corporation, a new enhancement instrument whereby the protection seller or investor sells a put option to the protected buyer on the insurer's underlying structure with certain conditions when the enhanced coupon of the bond will be the option premium. So that's why the most famous these types of structured bond will be the issued by the Fannie Mae and the Freddie Mac in the US, the mortgage corp in US. Because of the mortgage corp, because they would like to have a call option embedded on the bond, so that he can early call the bond in case somebody will pay the mortgage early. So that's why we have to do. But in Asia, we seldom buy this mortgage back because either it only trades in the New York Times, and second that the yield is lower than the normal corporate bond because it's government guarantee, not assumed to be government guarantee because it's a government owned mortgage company. The other type is that I would like to discuss we call it. This is a very, you can, if you go into the website and whatever you search for this is a very unique instrument issued by bank or international large bank. We call it the perpetual subordinated contingent convertible preferred securities. A very long name. In essence, it is the bank capital, or we call the additional tier 1 capital. These instruments happen after the global financial crisis, when a lot of international banks having difficulty and have financial difficulty, and they have to replenish their capital. But in order to replenish capital, they don't want to issue new shares, because when they issue new shares, they will dilute their shareholders' earnings. So that's why they would like to issue this kind of AT1, additional tier 1 capital. So the tier 1 capital basically is fulfill the Basel III requirement. So right now, after the financial crisis, the regulator require the bank, in order to stay permanent or stay safe to operating business, they need to maintain the core capital up to certain percentage. So that's why they, in order to maintain the capital they have to issue, this will be classified as the capital stock or perpetual subordinated. The reason why, because perpetual, that means the bank can decide when do they want to call the bond. It's not investor. If the bank do not call the bond will be perpetual forever, just like equities. And in exchange for that, they will pay usually a higher interest rate than a normal bond. And then they usually have a term that they can early call or roll it over. Say for example, for this one, it is they issue in 2020, and this is a non-call 10 year. That means that for the first 10 years, the HSBC will not call the bond and then pay the coupon accordingly. And then they will, the first call period will be at 2030. And then they will reset if not call every 5 years for the update reset the interest rate. And then the option redemption is the issuer's discretion in whole or in part any business day during the 6 month ending the reset date. And thereafter they will reset the according to 5 years US Treasury yield. So this product have been widely used by private investors and also some of the insurance companies because it is a bank capital, people pretend to be safe. However, some banks, actually different perpetual, different AT1 have different special conversion terms. The conversion term is that here. Automatic conversion upon a capital adequacy trigger. So in case the capital adequacy or capital adequacy is below 7%, they call Tier 1 ratio. Below 7%, the bank will convert the preferred share into ordinary share. That means no longer subject, no longer a bond or perpetual bond and become an ordinary share. And then there are also some kinds of rules according to the government bail-in rules. And then so in the essence, this AT1 will be subject to permanent loss in case the bank is in difficulty, just like a shareholder. So shareholder will be the least priority in claims. And it happened that attract a lot. Why we want to know that? Because it attract a lot of attention that Credit Suisse did not Credit Suisse, the Swiss government did force the Credit Suisse to default its CD1 last year. So that's why all the AT1 investor is total loss. So by way of, because Credit Suisse, after making so many losses and then become non-viable under the rules of the regulator, and then being taken over by UBS. But however, under the normal circumstances, these banks are much safer now because they have a highly regulated environment. The government put a very strong eyes on them, the regulator, and then test their capability every year. They have a stress test every year. Also at the same time, they require a much higher Tier 1 ratio. And then that's why the gearing ratio has been reduced. That's why the possibility of huge loss become non-viable is pretty minimal. And then also, right now, the CEO of this systematic important bank will be fined or giving back all the previous bonus if they did something wrong. So that's why the bank CEOs will no longer taking high bets for his shareholders' money. And then that's why the probability of loss is also low. So that's why now, but still you have to watch out the critical level and the critical terms, etc. So I still have something to cover. Maybe we'll cover next time because we don't have enough time. What did I say on the exam? 9. Okay. Yeah. I don't know. 332加332等於332。